The owner of Rose Radios is a small trading business selling a range of electrical equipment. We've got the following info from the balance sheet. The business applies the conservatism principle to the valuation of inventory, and we have 3 bits of additional information. The loan from GUD Money, so that's that loan here, is repayable at the rate of $500 per month. The phone bill owing, this one here, is actually the owner's personal mobile phone bill for last month. And lastly, the firm's stock here is actually outdated, and some of it needs to be written down, and it has a current estimated market value of $31,000. What we're going to do is prepare a classified balance sheet. So what that means is we take the assets and split them into current, which are assets that will be turned into cash or used within 12 months. So things like cash, inventory, accounts receivable, or debtors. We also break them into non-current assets, assets that the business will own beyond the next 12 months, e.g. property, vehicles, and IT. Liabilities, we do the same. Current liabilities are debts that must be repaid within the next 12 months, e.g. bills and expenses, phone bills, and so on. Short-term loans, accounts payable to creditors, and anything to do with having to pay the government back, like tax bills, because that is always due within the next 12 months. We also have non-current liabilities, which are the debts that will be repaid after the next 12 months, e.g. your long-term loans and your mortgages. Based on that, we can now take the information we've been given here and go and prepare a classified balance sheet. So I think the best way to do it is to actually go section by section. So what I mean by that is let's go and look for all the current assets first and start with cash at bank. That is a current asset, so that will go in. The next asset we can see is stock, so we've got to put that in. That's a current asset. We've got an issue with the amount. Remember, the amount is not $34,500. We are told some of the stock is old and has a current market value now of $31,000, and we're also told that this business applies the conservatism principle, so it's going to recognize an expected loss. So in this case, we would actually value that stock at $31,000. Debtors or accounts receivable, either term's fine. We're going to put that in for $1,800. And that is all the current assets, so we'll total them up in the right-hand column there and get a total of $34,100. Let's now go and tick off all the non-current assets. So we'll look through the items we haven't used, and the first one we'll come to is the computer equipment of $18,400. Next, we have fixtures and fittings of $35,000. And lastly, we have vehicles of $80,000. So we've now finished that section. We'll total it up and get total non-current assets of $133,400, and we'll total up the asset side by adding current and non-current assets together, and we'll get a total of $167,500. Let's go and do the next section, which is the current liability section. The first liability we come across is tax bill owing. That's always considered as current. Likewise, creditors, people we owe money to, could be because we bought stock from them or they provided us a service and we haven't paid for it yet. So that's a current liability. Then we have the loan, that's $32,000, but we're told some information here. We're told the loan is repayable at a rate of $500 per month. The current liability section is the amount of the liability for the next 12 months. So if it's $500 per month, and it's 12 months due in the next current 12-month period, then we say the loan to GUD Money is $6,000. However, that is just what's due within the next 12 months. We've got a total loan of $32,000, so we're going to have to come back to this item and reuse the rest of it later. The next item we have is phone bill owing. Phone bill owing is always a current liability. However, we are not going to put this in because we were told with the additional info the phone bill owing relates to the owner's personal mobile bill for last month, and based on the entity principle, the transactions of the business and the owner are separate, and the business shouldn't be paying the owner's personal mobile phone bill, so we're going to leave that out. We can now go and total up all our current liabilities and we'll get $10,500. We now have the non-current liabilities. Got the leftover part of the loan, so it's a $32,000 loan. $6,000 is due in the next 12 months, so that must mean $26,000 is due after 12 months. So that's the amount we're going to put in the non-current liability section. Lastly, we're told the mortgage, which is a loan for a property, that is due not until 2019, so we will put that in as a non-current liability for $80,000. And we've used absolutely everything there, so we'll total up the current liabilities and get $106,000. Now, we don't traditionally add up total liabilities here. There's no problem if you do. So we're just going to leave those two figures as separate. I'm going to move on to the owner's equity section, where the only item we write in is capital. What we don't know is the amount. We can see there's question marks. So to remember that, we need to remember our accounting equation, which is assets equals liabilities plus owner's equity. So if we get assets, we can see the total assets were $167,500. That equals the total liabilities, which if we do add them up is $116,500. And just applying a bit of arithmetic and algebra there, we can solve for X and say that owner's equity must be, or capital must be, $51,000. Now we have that number, we're going to add up the equity side, and we'll add up the current liabilities, the non-current liabilities, and the owner's equity, and we'll get total equities of $167,500. Whoops. And what we've got is a balance sheet that balances. We've got the asset side showing a total of $167,500, and the equity side showing the same. So obviously, given the name of it is a balance sheet, it has to balance, and we've managed to get this balance sheet to do just that.